Hey everyone, welcome tonight. This is Ken from Marketfy. I want to welcome our panelists tonight. We have Price Headley from BigTrends.com,
Hi, Kenny. Great to be here.
and we have Todd Schreiber, who is the ETF professor. He writes for Benzinga.com. He also has a ETF professor newsletter and research on Marketfy.com, one of his products.
Thanks a lot for having me.
Absolutely. And last but not least, Dan Riley from Mr. Topstat. How you doing, Dan?
Thank you. You guys can hear me very good.
I think so. So let's get started here again. We are going to be talking about the whole gold market crash. The past 30, 40, 50, maybe even 100 thousands of years, gold has always been something that people consider a safe haven. So what we really want to address is gold still a safe bet? Is it still something that you can trust, that you can put your money towards when the market doesn't seem to have a lot of hope, when there's a lot of questions in the air? Can you feel comfortable putting yourself in the hard commodity of gold? So we're going to start off, and each of them are going to kind of break down their analysis, what they think the issue is here, where they think the potential opportunities and threats are, and try to make sense of this for us. And then we're going to open it up to a discussion. Price, do you want to get started?
Yeah, my pleasure.
Okay.
All right.
Let me move this screen over to you.
I want to welcome everybody here tonight. I know we've got kind of a tight timeline, so we're going to go at a pretty fast pace. Where is gold headed? Obviously, if you look at a daily chart, and what I've got here is a GLD. These are just pulled off a trade station, but you can pull this from a lot of different places. GLD on a daily chart up here on the top left. And you can see it's been a disaster basically for gold since the October peak. You can see we were up on the GLD into the mid 170s. And now we plummeted. You saw the worst two-day drop in gold prices going back 30 plus years. So an incredible decline there. But you can see if you looked at a 200-day moving average, which is your gray line here, and it's sitting up here at about 160 on the GLD, roughly equivalent, give or take, to about $1,600 an ounce on gold prices. And bottom line is that's been broken for the last several months. What I would suggest that you pay attention to, though, is not just the 200-day. I think you've got to look at some other indicators. I'm going to share with you some of the tools I look at, like Larry Williams' percent R or percent range indicator. We actually look at that as kind of a general trending indicator. When you go especially strongly overbought or oversold, we were in a real bullish period last year, and you can see now more often than not, we're trading the bottom half of that range. That means that we've been making new lows, and then when we bounce to basically kind of a resistance area. And it's especially confirmed not only by the commodity channel index, the CCI, which is that yellow line, which is just coming back into what I call a retest area here on its current bounce that gold's having, but also the directional movement lines on the bottom panel. I know it's a lot to absorb in a short period of time, but what's happened ever since these directional movement lines crossed to the downside and then broke down back here in mid-October, that was a bear confirmed trend, and each one of these little test points here has marked a key resistance spot. So that was a big resistance level up there back in late November around Thanksgiving. Another one back in mid-January, big resistance. And you can see you got another one here in early February, another resistance level right before the breakdown. And then we had another one where we bought options on the GDX. That's the gold miners. We're going to talk about that. So these are great spots to put on bear trades coming off of those tests. We got close to one right before the plunge. It needed to rally a little bit more to be officially one of those key test points. But look what's happening right now. The red line is starting to come back down. That's the new lows, obviously, because we're making short-term bounce higher lows. And we're starting to get near one of those test points again. We're not quite there yet, but what that implies is that basically somewhere back in this 145 level, I'm expecting to be overhead resistance, and gold is vulnerable. Now, when we look at, that's the daily chart. It helps you a lot when you take a step back, just like if you were looking at a painting up close and just seeing all the paint dots. It helps to step back and see the bigger picture. Here we look at the weekly chart with those same indicators, and you'll notice we'd been in that monster uptrend back in prior years. You can see all the directional movement was basically positive, essentially going all the way back until late 2011. You had the very positive directional movement period. We were just steadily trending up. We had several percent R buy signals as we blast into overbought territory, and then we keep going. Those are your strongest phases of a move. Now, as an options trader, I know I'm going fast, but we got a lot to cover in a short period of time. As an options trader, I'm looking for that speed of movement. I'm looking for these quick surges. That's where we can trade calls on the upside, or more recently, you can see on the downside, we've got us going into the oversold area and now giving what we call a bear retest. So this is still a bear market here, and these bands are a couple of bands that I like to look at. The acceleration bands I developed in purple are now in a major acceleration on the downside here below that lower band. You can see when we were moving out above those on the upside, we had some big rallies back here. Now we're still vulnerable on the GLD to another potential down leg. Also, your directional movement lines show a very strong trending market on the downside with the ADX headed up on the weekly chart. Now, all these things together say, but look at the monthly chart, okay? We're not really truly broken on the super long-term uptrend going back. GLD's only been trading since back in mid-2005, but when you go and you look at it and you say, okay, what's happening here? We definitely have ended the strong directional trend phase, which was really in place here, the best part of that trend from about late 2009 on the monthly chart. The strong trend is what we want from an options buying perspective. Now we're into the trading range. You can see we hit the high of the trading range on the percent R indicator and it stopped. Now we're getting near the low of that trading range down to the 20% level on percent R. And notice what's happening to the DMI lines. We just had that key cross point right on that low when it plunged down there to 130. Now a lot of people ask, why did it plunge? You know, why did it drop so hard, the worst drop in more than 30 years? Well, there's a lot of speculation about that. People claim it's because you're seeing, you know, weak data out of China. People claim it's because maybe some of the big hedge fund players like John Paulson and some others might be getting forced to liquidate. Paulson had something like $9.5 billion invested in gold and lost about $1 billion over just a less than a week. So, you know, that's a bad week, right? But bottom line is that you can see we're not truly broken on the long-term chart unless we start headed down below this 130 level. So we're watching that very closely. Below 130, that would suggest bigger declines. And you can see the long-term support is back here at $100. Okay, so if we break 130, I think we're going back to $100 or about $1,000 an ounce on gold if it breaks. If it doesn't, I think we can bounce back somewhere into the 150 to 155 zone, as that's the next big resistance on the long-term chart. Now, what about other ways to play this? That was GLD. Now we're looking at GDX here. If it's hard to read, let me just write it in here. GDX is the gold miners index, and you can see compared to the last time that we went oversold back in the financial crisis in 2008, gold stocks got walloped. Why? Because even though gold did okay, gold stocks are just that. They are stocks, and all stocks got pasted back in 2008 because money managers were being forced to liquidate. You can see the GDX had one little period here where it was in that decent little uptrend. It wasn't very long of an uptrend. It lasted maybe about a year and a half before the official exit here for essentially a break even to a slight losing trade by the time we broke down on that key support and then violated it in here. So GDX is one that we actually came up with a bearish trade on for our subscribers back here over the last couple of months because we had this big long-term breakdown. Now we're going to the oversold territory, and you say, hold on, isn't oversold supposed to be a buying area? Not if it stays in oversold territory. That shows you institutional sell pressure, and you can see, looking back on the long-term chart, that takes you back to a potential double bottom target around 20 on the GDX. We're not anywhere close to that yet. We're at 30 roughly. So this is a vulnerable sector here that could continue to drop. And what I really don't like is how GDX is doing so much worse than the GLD. So if I was forced to be long something, I would rather be long the commodity of gold and shorting the gold stocks. They're clearly underperforming if you had to be long one and short the other. Now, when you talk about gold stocks, here's one of two quick gold stocks I want to share with you, and that's Barrick Gold, ABX. And you can see on ABX that we have actually been in a sell signal going oversold back here at about $35 confirmed, and now we're sitting here at about 20 bucks. And you say, but hold on, gold or ABX does have some pretty big support going back to the 2008 low here in the 18 to 20 zone. That's true. We could indeed get a bounce, and then it could indeed be another short back into the 23 to 25 resistance bands that I'm showing as now
All right, it sounds like the audio has been lost on Price. Can you all hear me out there? Yeah, I apologize again. We have been on the phone with GoToWebinar, my colleagues, while we're doing this as they try to work this
And
out.
1 second, looks like I might have
There,
lost you there for just a
there he
second.
is. We
Sorry
got
about
you
that.
back. We got you back.
Okay, thanks. So
Yep.
let me just finish this concept, which is just ABX breaking down. Then one more that I think you've got to watch here is GOLD. Now, you think that sounds like gold prices. This is actually a stock, GOLD, and it's Rand Gold Resources here. This is pulled out of TradeStation, remember, but you can do this on a lot of different charts. This stock has actually held a lot stronger than the rest of the gold market. It's one that I've liked back in 2008. It had a little pullback to what we call a key CCI retest off of that low here, and that was a great buying opportunity on GOLD. This is a very leveraged stock to gold prices because they sold out of some of their mining interests where they're actually pulling the gold out of the ground, and they took that proceeds and they bought royalty rights to other miners. So it's almost like an option on other gold names and gold miners, and so it's basically like a leveraged way to trade gold prices. You can see right now that this one, while it has not broken, it's crunch time here, right at the oversold level of around $75, and so we're watching this extremely closely. To me, this is my favorite name that I want to potentially trade. Either if we break down below 75 on the downside, it's going to have a lot of risk, probably eventually back to the 40 level when that does break, but if it holds, we can bounce all the way back up between the 100 even 120 target. So all this says, watch this name as a really actually a leader right now. If gold bounces, you want to be on GOLD rallying back up, but if it breaks down, this one's going to get hit the hardest. So watch for volatility on this name here. We're watching it extremely closely. And so I'm going to hand it over. By the way, if you want to get some of our free reports and things, you can go to bigtrends.com/free to sign up for that, and we'll hand it over to our next presenter. I'll let Kenny do the handoff here, and then we'll come back for a Q&A here in just a little bit.
Appreciate it, Price. And definitely, everyone, make sure you go check out bigtrends.com/free. Price and his team over there do some awesome stuff. We've been following along and working with them in some capacity for a very long time now. And again, Price, thank you for the time, and we'll definitely, once we get Q&A, get you back in here. What we're going to do now is we're going to move the screen back on over to Danny from Mr. Top Steps. All right, Danny.
Long story short, I think there's a little story here, and it goes back over a long, long period of time. I've been on the floor for over 35 years, and my desk operations is CME. We've had desk operations in just about every area. And gold was always kind of one of those elusive things that, the CME group had varied success with in the early 80s. And they had a big pit, a ton of traders trading gold at the old CME, and then they lost it to New York. Now, my background has always been working with big traders and big order entry, and my background comes from program trading at UBS, doing the UBS stuff and working with Marty Schwartz, and a lot of big hedge funds and banks. So the desk itself has seen a lot of different order flow over the years and big size. And I'll get to kind of how this all ties in a minute. But when I look at the way the gold collapsed over the last couple of months, I look at really most of the way it accelerated over really since the middle of April, and a little bit before. But around April 10th was when Goldman came out and they started talking about their short-term gold forecast, and they had already been negative. I think 6 weeks before that they had put out that they were looking for some type of correction in gold. It really did turn bearish, and then during that same time, their analysts were coming out with some very skewed opinions of the downside in gold. Now, again, we're on the trading floor. We look at all the products that move up and down. And one of the things that I was talking to Price about before, and I'm honored to be on with Price. Price is a well-known guy. He's got a great company, throwing in charts and doing all the things he does. I'm not of that caliber. What I am is I'm a street guy that's been around these markets for a long time. We've seen this kind of price action before, but what I was talking to Price about is that once gold started really, really heading south. How much of that was sell stops and programs and algorithms? We never really kind of saw these $100 moves in gold, the way we've seen them over the last couple of years. And yeah, a lot of it is tied to, margin requirements. But then again, my question is it overinvestment? Is it people chasing money, chasing returns into a market that they don't have a real lot of knowledge about? But anyways, those big forecasts that Goldman came out, and then what we've noticed, and this is again, I'm not a chartist, I'm a floor guy who's been around for a long time, and what we took away from all this big drop in the crude, in gold, was that people had once the information came out about Goldman, you can see where it started to accelerate on the 10th, and then as it accelerated down, the CME came out with their margin call. Now, their margin increase. Now, what we've seen over many, many years is when the CME does that, it's literally acts as like a bottom, as a buy signal. Now, I know you guys will shake your heads at that, but many, many clearing firms, and including the one that we work for, we know that in those margin departments, when there's increased liquidation and it comes to a head, and it comes right into a margin hike like that, that is what you call forced liquidation. It's kind of like the last man out kind of thing. And what they say is that the clearing firms, you're on call for 1 to 3 days. You can, if you've got the money, you've got 3 days in order to meet those margin calls. Well, in these circumstances, when the clearing firms are holding these options that are exploding or futures that are being waymarked against these traders, they don't want that exposure. They're going to go right along with the merc. So, and what I'll add to this is that it acts almost like a bottom picker for, it almost works as an indicator for picking bottoms after this has occurred. Now, what we know is that there was a couple of firms back in the late 80s and 90s. One was a company called LFG, and it was run by a CRT partner. His name is Steve Clement. Very nice guy. But he had a guy in his back office that's actually still around. He works at a company called Advantage Futures in Chicago. His name is Bill Steele. And they allowed Bill Steele, the margins guy, to trade his own account or a house account. And they allowed that because Bill had a unique opportunity to look at when the last of those margin calls were being met or when the last of those margin calls were being liquidated. So it's definitely an indicator that we watched for on the floor for a long time. Now, as far as my background in gold, now this goes back to my next slide, is I actually ended up on the floor of the CME back in the 80s and in 1980s. Gold ran up to 850, and I was actually a pit clerk in the gold pit back then, doing arbitrage between the cash and the futures. Now, at that time, I remember the Royal Saudi family was heavily involved in buying gold, and I know that the Hunt brothers were involved in buying silver, and maybe when we come back on, we can talk a little bit about that. But here's my question: Is it an investment or a scalp? The way I see it from the floor trader's perspective, it's a difficult trade to be trading during the day. I know that people trade it, on a day trade basis, and they buy and hold, but from my experience over the years, it's almost as if people, it's something that it's not on their radar all the time. But then when gold starts to move up, they feel like they're missing something. And the funny thing about it is, and I'll tell you, the guys at my desk, members that have been on the floor for a long time, when they started seeing gold get above 1,400, 1,500, 1,600, they were buying the futures. I mean, in my opinion, if you really thought they were good, you just buy the future. But guys at my desk, educated traders, and I'm not saying that people aren't educated that did this, but they were buying silver and gold bars, And my question is, what happens when that kind of stuff happens? I think what happens is it becomes an overinvestment product, and then you get these mammoth corrections like what we've seen. And then, the last one is just a simple chart. On the 15th is when the CME came out with their margin increase. On the 16th is when the gold started rallying, and we've rallied 165 points. And like I said, this is kind of a floor view, and it's not really a technical view, but at the same time, I think we can use price for the technical side, and you can use me for the street smart side. And that's really all I've got to say. I mean, I think it's really more of a kind of a view from a floor trader kind of thing. But I want to thank you guys for letting me come on. I'm looking forward to, opening it up for questions a little after.
Absolutely, Danny. I appreciate that as well. Yeah, we have some questions, some really good ones that have been directed to you and Price earlier. So we're definitely going to hit all of those when we open things up. I think what we'll do here is we'll switch the screen over to Todd and have him break down things from his perspective, then open things up and bring Kyle, president of Benzinga.com and Marketfy.com, in to run and moderate the open discussion. Todd, screen should be prompted to you to accept. So whenever you're ready, sir.
Yeah, thanks a lot, everyone, for coming. I'll just give you just a real quick overview of my background, like Price and Danny did. Before I came over to Benzinga, I traded my own account at a prop firm here in Southern California. I live in Orange County, California. And then probably just a couple of months right before the financial crisis started, I moved over to a long-short equity hedge fund here in Orange County, where my specialty was ETFs. That's what I focus on today. I'm the ETF professor on Marketfy. But while I was at the hedge fund, I basically introduced ETF trading to the desk there, focusing a lot on materials, energy, emerging markets, financials, those sectors, because during the financial crisis, those things were great shorts. But I want to talk about gold from the ETF perspective. I think that's what a lot of folks are familiar with. Price really touched on GLD. That's the biggest gold ETF. An interesting thing about the major gold ETFs, GLD, like I said, is the biggest. It's now, once upon a time, it was the second biggest ETF of any kind in the world because of gold's recent struggles, if you will. It is now the third biggest. SPY is the biggest, and then the Vanguard Emerging Markets ETF is the second biggest. I'm talking by assets under management. But you can kind of really combine a lot of the things that Price said and a lot of things that Danny said and apply them to the gold ETFs. Like I said, major one's GLD, another one is IAU, a company called ETF Securities has a couple, and the tickers are SGOL, AGOL. Those are all ETFs that are backed by physical gold. Now, what a lot of folks don't understand is that when you own those products, you're essentially owning paper gold. And when you sell a share of GLD, State Street, who is the issuer of that ETF, does not deliver physical gold to you. There are a couple of new products that are kind of new ETFs that are looking to do that, or that do somewhat deliver you physical gold. I'm not going to touch on those right now, but it is important to think about the impact that an ETF like GLD or IAU, which is the iShares equivalent, that they have had on the gold market, because a lot of folks try to figure out, well, what's the tail that wags the dog of gold futures? And these ETFs are not that old. Danny was talking about looking back at the gold market in the early 80s, and when we take a look at the gold market from a historical time frame like that, we have to remember that GLD didn't exist until 2005, and then IAU came along a few months later, and those ETFs do a good job of mirroring action in futures. Of course, the important thing to remember is ETFs trade like stocks. GLD and IAU trade on the New York Stock Exchange, which the hours are longer than the futures market. So I think that's an extra hour and a half or 2 hours in the trading day. So it's not always a 100% accurate, but purchases and liquidation in gold ETFs can sometimes, and we've seen this recently, can be a little exaggerated in comparison to what's actually going on in the futures market. And something else to consider with those physical gold ETFs that a lot of people forget is they are treated much differently than traditional ETFs when you want to report capital gains to the IRS. It's great when we sell a stock or ETF for a profit, and normally if you own a regular ETF that just has stocks, and you held it for say a year, your capital gains expense, I think, is at the most 15%, depending on, or 20%, depending on what your tax bracket is. But GLD and IAU, and this also goes for SLV, which is the silver ETF backed by physical silver, they're treated as collectibles by the IRS, and it's almost, I hate to put it like this, but it's like selling a baseball card, and your rate of taxation is much higher. I think it's 28 or 32% or something like that. But that's just a little bit of background on those particular products. What I want to focus on here, I'm going to just try to whip through this so we can get to the Q&A portion of this, and Price gave me a good lead-in because he started talking about the miners, and obviously he came at it from a very technical perspective, and I want to kind of look at some of the fundamentals that are impacting miners, the gold miners specifically. Right now, this first chart that I've got up is basically we're talking about the margins for miners, and this is strictly in dollar terms. We're going back here to 2001, and you see that, well, once upon a time, the price of gold and what it cost a gold miner to get it out of the ground, was pretty good. But as this has gone along, and obviously a lot of this has to do with price increases in other commodities. I mean, gold miners have to pay for gas, for equipment, and steel prices for bulldozers, and all those things have been factor into the equation here. So we get up here to 2012, and this is a very concerning trend that we've seen here. Actually, really over the past 3, 4, 5, 6 years, the costs gold miners, Barrick, a great example, have of pulling gold out of the ground keeps increasing, and there's some speculation that earlier this year, I believe the World Gold Council even put out a report that said potentially within the next, at the end of this current decade, so 2020, maybe just a little bit later, 2022, something like that, you're talking like in their estimation, we might need gold at $3,000 an ounce. So roughly a double from current levels for a lot of the miners to be profitable. I'm going to pull up another chart here. These are 5 of the major miners. I just pulled some names that I think folks might be familiar with, and these are major holdings in the GDX that Price mentioned. These are the first quarter costs, not what these companies sold gold for. This is what it cost them to get gold out of the ground. This is Barrick, Newmont, Goldcorp. Humana is actually a very good manager of their costs in Q1 of this year, and Agnico Eagle. It was important to realize about this chart, and just because of time constraints and limited space, I should have included this, and I apologize for not doing so. These costs, even with Humana, which is one of the better ones in terms of managing costs, as I said, these costs are all noticeably higher than what was seen even in Q4. And this is a fundamental trend that is very damaging and has been going on now for a few years, that is having a deep impact on not only these companies, but obviously the ETFs that hold them. And let me illustrate for you how these companies can impact GDX. This is the 5 companies I just showed you. Barrick is here in green, Goldcorp in the orange here. So we basically have 5 of the more recognizable names in the GDX. This is 20 called Barrick and Goldcorp almost 22%, and throw in Newmont. Add all these up, we're over 40% of the largest gold miners ETF, one that has been in a noticeable downtrend for 16, 18, 20 months. As Price noted, a major problem that I would almost characterize it as vexing for investors is, oh, well, GLD has gone up over the past 2 years. Gold futures are noticeably higher over the past 12 years, excluding what's gone on this year. Gold futures have been in a 12-year bull market, but miners haven't performed in sync, and I mean, the value destruction for investors who have said, well, I want to play gold's uptrend through miners instead of physically backed ETFs or through futures is not been a good idea. I'm going to show you a chart here. This is 2010. The blue line is GDX. One important thing to remember about GDX is that it's not as old as GLD. I think it started trading about a year after, late 2006. And the green line in this chart is GLD. This is a chart, like I said, for 2010. 2010 was the last time that GDX outperformed GLD. Do a 3-year chart. The blue line here is GDX. The green line is GLD. Look at it. We're going to move over to another chart I thought you guys would be very interested in. This is the volatility of mining ETFs. There's a couple of other ones that don't always grab the headlines the way that GDX does. GDX is the one that is home to some of the stocks that I just showed you. You know, Barrick, Newmont. Those are some of the big names. But there's also a small cap mining ETF. Also issued by Market Vectors, just add a J to it, GDXJ, and then Power Shares. I left a couple off here, but PSAU, that one is kind of a menagerie, gold, silver, some of the other metals miners. But this is just year-to-date volatility. It's almost 39% on GDX, almost 44% on its small cap equivalent, but GLD is noticeably less volatile, so it really kind of leaves me telling people ask me a lot, oh, what are great ETF avenues for getting involved with gold, and I haven't recommended the miners for probably over 3 years. I think it was maybe Q2 of 2010. I was interviewed by someone, and I was moderately bullish on the miners back then, but this is a very, very broken trade at this point. Another question that I get a lot is, well, hey, can gold futures or something like GLD or IAU, can those products come back? I believe so. It's a tough long-term hold. The ETFs, they have pretty decent expense ratios on them. I think GLD is 35 basis points a year. IAU is a little bit cheaper, but at the same time, the risk there is there's not a huge reward for long-term investors unless you're very, very patient, because those products don't pay dividends. Now, yes, do some gold miners pay dividends? Yeah, absolutely. But as we saw with Newmont recently, because of their rising costs, they are apt to cut them. So there's just a lot of risk involved with the miners element to the gold trade at this point. And it very much, as I said, Price did a great job of pointing it out at a technical level. Fundamentally, this is a highly damaged trade. Just real quick, I mean, I would say the adventurous among us, there's one really good way of shorting miners if outside of the options market. This chart that I pulled up that I didn't include in my presentation is the orange line is of an ETF with a very easy ticker to remember. It's dust, just like dust on your desk or something like that. And this is the triple leveraged equivalent of inverse answer to GDX. It's 3 times the daily performance of GDX's underlying index, which is the NYSE ARCA Gold Miners Index. So as you can see, this has been a pretty awesome trade for a very long time. I don't recommend holding it, any leveraged ETF for this long. The blue line in this chart, to show you just how bad things can get for gold miners when leverage comes into play, is Nugget NUGT. That's if you were bold enough to be bullish on gold mining ETFs, and I would say if you're going to do that, treat it as a trade, not a long-term investment. A couple other things just to point out real fast, and we'll kick it over to Q&A. There's a few emerging markets ETFs, and I've analyzed this several times on Benzinga.com that have really been decimated by the air coming out of a gold balloon, if you will. And I know a lot of folks love emerging markets, ETFs. That's one of the ways we've made a ton of money in my product, ETF Professor. But we've really been avoiding countries that have leverage or correlation to the gold trade. South Africa, that ETF is ticker EZA. South Africa is the biggest gold producer in the world, or number 2. They're also the second biggest palladium producer and the largest platinum producer. So when the wind has come out of gold sales, it has a tendency to drag the other metals down with it. I would very much avoid the South Africa ETF until we see these metals really start to rebound. Another one, and this is one I've wanted to like, and now with gold prices struggling and weighing on silver, I can't like it. It's the Peru ETF. It's ticker EPU. Peru is one of the larger gold producers in the world, but it's to kind of make matters worse, it's also the largest silver producer. So those are 2 that I would, if you're going to trade them, either buckle in for the long term or look for put options, because I would not be wanting to be long those particular ETFs right now, because they have significant exposure to gold and silver miners. About a quarter of the South Africa ETF's weight is materials stocks, and over 42% of the Peru ETF is devoted to material stocks. So that's all I've got. I'll toss back to Kenny for Q&A.
Thanks a bunch, Todd. Appreciate that. So what I'm going to do is we're going to bring the screen back on over to us, and I'm going to bring in Kyle Bazzi, the president of Benzinga.com and Marketfy.com, and we're gonna kick off this Q&A. We have a lot of good questions coming in. Don't feel like you can't keep asking them, because we have some time here to get to a bunch.
I appreciate everyone, Price, Todd, and Danny. I really appreciate you guys coming on today. Got a lot of great questions we're going to get to here. As Ken introed me in, I am the president here at Benzinga and Marketfy. One quick thing before we get started on the Q&A, and Stan, Robert, Jo, Audra, Tracy, you got a ton of good questions coming in. I wanted to let you guys know that we love doing these webinars, because it's the information that we really get from our readers that you guys really want to hear. So feel free to also send us topics for next time as we continue to do these about once a month. So without any further ado, though, I'm going to get some questions going, then I'll direct them to you guys, the panelists. So feel free to jump in whenever you guys feel, and start debating back and forth. But what I really want to get here in the last 15, 20 minutes of the webinar is get a really good market feel for where we think gold is heading, and all the implications from that. So that's where I want to start. And I got Robert here. Robert P. asked, how safe physically is gold in GLD vaults? And kind of playing off that, do you guys think that with everything going on, that physical gold is a solid way to go in more of a longer term play here? And Todd, I want to start with you on this question.
All right, cool. So that was Robert that asked that question?
Yep.
All right, that's actually a really good question, Robert, and that's one that I have gotten from folks when I've done other webinars or live seminars for folks about ETFs. I've probably gotten that question hundreds of times in the past 4 or 5 years. I think we're, and I don't want to put words in Robert's mouth, but I think where he's going with that is probably one of two directions. I mean, a long, long time ago, the U.S. government did seize gold from American citizens. So typically, that's one reason why folks ask me that question. There is another reason why people wonder about the security of gold in GLD's vault in particular, because a lot of people do wonder, is GLD actually even holding any of this gold? Do they actually own it, or is the ETF itself a big scam? I don't want to get into validating or not validating conspiracy theories here, but that particular conspiracy theory, as it pertains to GLD, in the past has had some momentum. Now, I would say to you, am I worried that there's going to be a real gold seizure like we saw a long time ago? No, I don't think so. If you are worried about that, or you want an ETF that's like GLD, but that does not store its gold in the U.S., and I don't believe that GLD does store all of its gold in New York. I think some of it's stored over in London. But there are two ways, two ETFs that I know of that are listed on the New York Stock Exchange, but store their gold overseas. And I mentioned them before. Actually, they're both sponsored by ETF Securities, and they basically do the exact same thing. They move in price unison with GLD. One is SGOL, and the S in that ticker, it stands for Switzerland. The gold in that ETF, that backs that ETF, is stored in Switzerland. And then the other one is AGOL, and again does the exact same thing as the other ones I've mentioned. That one stores its gold in Singapore. So if you're really worried about having your gold confiscated, then AGOL or SGOL would be the ETFs that I would look at.
Cool. No, great stuff, Todd. Appreciate that. And this next question is going to go a little more towards Price and Danny here. With the futures and options and commodities, the way you guys are playing it, what's the implications of something like the Fed meeting coming out recently, where they didn't raise the interest rates? How does that play into your guys's your strategy, especially when you're playing more of the short-term plays on the commodity here? Price, let's start with you.
Okay, Kyle, thanks. I would say, clearly from a short-term perspective, everybody's watching the Fed, and part of the rumor about the big drop that happened recently was the Fed in their minutes making some noises that they might stop some of their asset purchases by the end of 2013, which stopped some of the inflation fears, which sort of added to then all the margin selling and other kinds of pressures. It can become sort of like a self-fulfilling prophecy of selling begetting more selling in those little panic modes like we had with the worst one-day drop that Monday since 1983. But I mean, basically, from a trading perspective, I mean, the momentum can be very powerful with these vehicles, and from an options perspective, you will tend to see that when you're starting to see that happening, you're at the money options, which are usually the ones that have a lot of leverage, are also the ones that get most expensive. So the way we try to play it is, if we're buying a put, we're trying to buy a put, when GLD was, say, at 145, we might be looking at like a 150 put where you have a right to sell it at a higher price than where it's currently at, and that gives it what we call intrinsic value. In that example, like if you buy a 150 put and it's at 145, you've already got something that's worth that $5 or $500 per contract. So what that does is it kind of protects you, gives you a little bit of cushion, if you will, from some of the excess volatility, and then we'll even create spreads around it where we might sell another option against it to sort of offset the cost of the option we buy. And so bottom line, in a long story short, is just that we are looking at how expensive these options get, looking to trade them for short windows of time, and then being back out of them. Just to piggyback on Kyle's excellent response, basically there's been a lot of conspiracy theory about do the custodians actually hold all the physical gold to back up the GLD, and the good thing about being a trader is if you're going to buy and hold it, that would be a concern, but GLD traded 11.6 million shares on Friday. I mean, it's one of the most liquid vehicles out there. to trade. And so the options, behind, say, an SPY, the S&P 500 trust, GLD is probably my second favorite, just from pure liquidity of getting in and getting out, knowing you've got a lot of other traders in there. So it's not just you against a market maker, it's you against a lot of other traders, and that's going to enhance your liquidity, your ability to get in, and your ability to get out. So I'll hand it over to Danny now for more of a market maker perspective.
We got you here, Danny. Well, before he jumps in real quick, and Danny, let's get you in here. Just to piggyback off you, Price, we get a lot of questions about this all the time. When you get that kind of liquidity inside of the contracts too, especially on GLD, it's going to also tighten the spread too. So I know Danny has a ton of market making experience, but that's something to also look at is not even just an options contract that you want to buy that you think is maybe a great play. You got to make sure you can get it for the right cost as well. And we actually had Audra come in, and Audra, this kind of plays off of a little bit. You're asking if it's going to cost miners more money to extract gold, should that rise the price of gold? It won't. It's not going to rise the price of gold. What it's going to, in essence, when you're looking at the gold mining stocks, that's going to rise their costs. So if you're just looking at any other balance sheet or P&L for a company, if their costs are going up, obviously their profit margins are going down, which is negative for the stock, obviously. And actually, we had a lot of plays off of ADX a while back, right around the 32 mark when it was at a 52-week low. And that thing crashed all the way down to 17 just because of more speculation off that. Obviously, with gold getting killed too, but even during the recent rally of gold, you're seeing the mining stocks still having a lot of worries because of that issue right there. So it won't necessarily rise the price of gold. What you want to look at for those mining stocks is it's going to rise their costs. So,
hey, Kyle. Can
yeah.
I jump in? Also, one thing that people forget about is that in the 90s, Barrick was considered the safe way to play gold because they were hedging a lot of their production when gold prices were dropping. And then Barrick, back here in the 2000s when gold started going up, all of a sudden they were like, well, gee, we're falling behind. So they stopped hedging so much of their production. So, that's what happens in these cycles is that even the companies will chase in and try to say, well, we're not a hedged company anymore, so therefore when gold prices go up, you want to buy us, and of course that hurts them now that gold prices are going down and they're not hedging as much production as they did in the 90s. So it's another interesting point to keep an eye on which companies hedge by selling forward their gold versus which companies, a lot of them now don't hedge their gold in the futures markets.
Yeah, that's a great point. It adds a whole other variable, just the gold itself, which I think is a very, very valid point. One of the things that we had a webinar here about a month ago, and we talked a lot about Europe and the macro viewpoint on the markets with the things that they have been in the last 3 years. In the spring, we always feel like we get this Euro crisis coming in, and that's always directly correlated to gold because when things get shaky, we always go there. Todd and also Price, I want to bring you on this one. Todd, you're looking more for a longer term perspective. Do you even look at, and we had a ton of Euro questions today, do you even look at what's going on in Europe right now in terms of how it's going to affect your gold plays? One of the things that we had a webinar here about a month ago, and we talked a lot about Europe and the macro viewpoint on the markets with the things that they have been in the last 3 years. In the spring, we always feel like we get this Euro crisis coming in, and that's always directly correlated to gold because when things get shaky, we always go there. Todd and also Price, I want to bring you on this one. Todd, you're looking more for a longer term perspective. Do you even look at, and we had a ton of Euro questions today, do you even look at what's going on in Europe right now in terms of how it's going to affect your gold plays?
Yes, absolutely. And I think you were kind of touching, I mean, you directly touched on it the way you set that question up. In just, I would say in years past, or let's just say gold was behaving in quote unquote normal fashion, and we were in a normal year that wasn't a financial crisis year. So we were in, say, 2007 or 2010 or something like that. I'm going to take the financial crisis out of the equation. In fact, you know what? I'll even do a hypothetical where we strip QE and quantitative easing, and let's just assume that no central bank in the world was doing what they're doing right now, which is printing excessive amounts of money. So let's just say that the big, hypothetically speaking, the issue du jour was the Eurozone sovereign debt crisis. And we've obviously seen that these very small economies, Greece, Cyprus, Portugal, they have had a way of roiling global financial markets. So that would be in a more overall sanguine environment, that would be a very efficacious thing for the gold trade. People would say, okay, I want a safe haven, so it's either your options are somewhat limited. You have treasuries, the U.S. dollar, long the yen, or you would go to gold, either futures, physical gold, or some of the ETFs that I just mentioned. But the reality that we live in is all the things that I said in my hypothetical weren't there, but plus the Europe sovereign debt crisis is still going on. So what I'm considering right now is, I say, and I think a lot of other folks have said this as well, is, okay, Europe is having a sovereign debt crisis. The Fed and the Bank of Japan and others are printing excessive amounts of money, and that should be depressing the U.S. dollar. So all these things should be great for gold, right? But recently they haven't been, and that's what actually has me worried about holding something like GLD or IAU for the long term, because, like I said earlier, you don't get paid a dividend to hold it. In fact, you have to pay, the annual expense ratio to hold it. And it's troublesome right now that there are fundamental factors at play that theoretically should be very, very good for gold, but they haven't been. And 2 weeks ago, we had the worst, like Price said, the worst one-day drop in 30 years for gold. But there's still QE going on. Europe still has a sovereign debt crisis. So absolutely, I do take gold or Europe into consideration when putting on any gold-related ETF trade, and that's been a huge disappointment recently for those that want to be long gold. Is it should be going up, but it's not.
Thanks, Todd. Danny, you want to jump in on this one too?
Yeah, thanks a lot, you guys. I just get this kind of funny perspective that, it seems like gold as itself is something that people rush to trade when there's a lot of risk floating around. And that's when you get these, you get the crowd, or you get the big swing of people going into the product. And it seems to me that there's a little bit of lowered risk in the Middle East right now, and I'm not really quite sure that has a lot to do with it. But what it does seem is that once everybody gets all loaded up, and we've seen this, and I think maybe Price could jump in on this, is once everybody gets loaded up in gold, it seems like there's always this feeling that there's going to be this, like a big sell-off. And that's exactly what we've seen over the last, couple of weeks or a month. Now, one of the things that I always think about is when the markets do this kind of adjustment is that they have these kind of knee-jerk lows. Now, gold sold off to 1320, and that was the low that, after the margin stuff that the CME did. Now, I guess my question would be, when something falls apart like that, and it falls apart that hard, generally, my experience is that the decline's not over. And two, the other part of it is that if it is over, you're going to have to see a lot more back and filling. But the part of it that I think is important is to see some type of retest and see how gold acts down, at that April 15th low. As far as the quantitative easing part of this, as long as the Fed's going to be around printing money, you're going to get support out of the government from that. And I don't know right now, based on the way the Fed's talking, and I don't think any of these quantitative easing programs, QE3+, I don't think they're done by any shot. But at the end of the day, I think it's kind of like what I tried to say in my slides. It seems to be that it's a little bit more of a fad trade sometimes, that people want to be part of something when it's going up, and they all jump in, and then they're like deer in the headlights once it starts rolling lower, and that really, I believe that's the catalyst for the CME jumping up and increasing margins. That there's just too many longs that aren't hedged in the market, and thus you get this kind of big washout.
Danny, feasibly, you think that they can keep printing money like this, but it's got to end. Where does that end?
Well, it's really important to look at it, and one of the things I've learned from Marty Schwartz is that, the quantitative easing programs have definitely, and you all see that, as to how they've supported the markets over the last several years. I don't know how this, I don't know how we come out of a soft landing once they stop the quantitative easing programs, 85 billion a month, and more, and mortgage buying. Basically, what the Fed's doing is they're printing money and they're lending it to themselves. And at a certain point, there's going to have to be, there's going to be a payday here. And I think down the line that gold may, once maybe toward the end of this quantitative easing program, you'll want to look back to, get long gold again. But right now, I just don't think that it doesn't seem like it's in flavor. I mean, I'd like to kind of hear what the other guys, is the trade still in flavor right now, or is the back broken of this trade? It's a pretty big decline, and my own opinion is it's not over yet.
So, Danny, you think you're bearish?
Maybe I can chime in here. This is Price. I mean, I think.
Yeah, go ahead, Price.
Sorry about that. Basically, yeah, I mean, my take is that I think Danny's on to something, that this was a significant breaking of the back of the gold bulls, that we've been in a 10-year rally going back to 2001's lows. We came out of a 20-year bear market in the 80s and 90s after the early 80 peak in gold. So bottom line is that, I think Kyle also alluded to it as well, that gold should have been going up. Even Goldman, when they put out their bearish forecast that Danny alluded to that really drove us down, Goldman said that one of their drivers of making that call that they were being patted on the back for was because they were surprised that gold prices didn't rally materially when you had this Cyprus news that they were going to potentially confiscate people's wealth and savings accounts. And, we all know that just sounds ludicrous, although it scared a lot of people, thinking, well, was that the domino theory? If that's the first one that could start confiscating wealth, is that going to bleed into bigger countries and eventually cross the oceans over here? Obviously, that was rejected by the Cyprus parliament, but that was shocking that gold didn't rally in that. So Kyle alluded to it before, that gold should be going up with all this Fed quantitative easing, and it's not. Danny suggests, and I would tend to agree, that something bigger appears to be at play here in terms of the breakdown. So I think you can make a case that the breakdown under 150 on the GLD, roughly 1,500 on gold prices, was very significant, and that if we break roughly 1,300 on gold prices on the future side, or about 130 on the GLD, I think you can make a technical case back to even as low as $1,000 an ounce. Now that's if that breaks. If it doesn't, we may just retest it and hold. But I'm expecting we're going to get at least another test of those lows, and a good chance at undercutting them, because gold is just not acting right at all.
Folks, that's a huge point that Price just made. If we break through these, and obviously this is coming from a technical standpoint, if we break through these levels, we're going to be looking to test that 1,000 per ounce again, which I can't stress how important that is, and I keep hearing over and over again from all of our guys, is if we break through that. Price, one thing I was curious on, and for everyone that doesn't know, the CBOE opened up mini options earlier in the first quarter of this year. Have you seen that with mini options on in the gold sector? Have you seen anything change from that, or is liquidity and volume any indicators in that realm?
We're watching it pretty closely there, Kyle. I think it's a little bit early yet. They just came out in March, and so basically we're watching those. Obviously, we would love to see more and more liquidity coming into that. But for now, at this point, I don't think it's big enough to be statistically significant. We still put more of our emphasis watching the GLD, but I think the mini options, which trade like 1/10 the value of these other traditional options, so you can get more contracts, which attracts a lot of retail traders. Something that makes a lot of sense as a longer term idea. So we're definitely watching them, not just across gold and SPY, but even the Apples and Googles of the world. Certainly could make it a lot more appealing for a lot of people to trade those names.
Cool. All right, well, what I want to do now is get everyone's final perspective here on either the bullish or bearish outlook, and I would say through the rest of 2013. And you can even make a couple of caveats if if we get interest rates to rise at the end of the year or something like that. Todd, let's have you chime in real quick with your outlook for the rest of 2013 for gold.
Okay, I'll start with GDX because that's the mining ETF we've talked about. I mentioned it, Price mentioned it. I don't have the chart, but I've actually I talked about this with a colleague of mine who is a very good technical analyst just a couple of weeks ago. If GDX, and it is to put it mildly, a high beta volatile ETF, it's around 29 right now. I'll be generous and round it up to 30. Do I think it's possible that it sees 20 sometime even in the third quarter? Yes, absolutely. So if 20 does not hold, that is a line in the sand on GDX. If 20 doesn't hold, I will be bold enough to make this call right now. It's being recorded. I'll either be right or I'll be wrong. If 20 doesn't hold on GDX, that ETF will go to $7. I don't know if that will happen this year. Do I see significant price decay ahead for mining stocks and ETFs, GDX, GDXJ related ETFs? Yes, absolutely. I think the downside from here is significant. I think you have to be very, very careful with these things. They are yes, you can catch a couple of, and we've seen some recently, a couple of good days here and there where GDX might do 3% on Wednesday, 2% up on Thursday, that kind of thing, and you get 6 or 7 or even 8% in 2 or 3 days. That's nice, but that is not the overarching trend here. The path of least resistance with those things is down and significantly lower. In terms of spot gold or the physically backed ETFs, I'm definitely more bullish on those, but I would say tepidly so because as Price just mentioned, and Danny was kind of alluding to it as well, I don't think that QE is going to end right away. And it's also important to remember with the QE thing, well, the first round of QE came, I think, in 2008 or 2009, but gold has been in a 12-year bull market before now. So there was a bunch of years from 2000 or 2001 up until the first round of QE where gold was a good long trade. I would be very selective, I would say, in nibbling at something like GLD or IAU. I think the levels that Price mentioned earlier, those are very, very important. 1,000, if that fell, I don't think we will see 1,000 this year. I truly don't. I don't think 1,000 is coming. I would be scared about any further another drop below 13 or a legitimate drop below 1,300. But right, so that would be 130 on GLD. I think that if that holds, that would be a good area to nibble at. So I'm a little bit more bullish on physical gold than I am the miners. I'm frankly very, very bearish on the miners, and I would not be using those as long-term instruments.
Cool. Thank you, Todd. I appreciate it. And I'm going to bring in Price, and I'm actually going to prelude this a little bit. This is actually a question from EL, and let's get your final thoughts on it, Price. It says gold has gone up $160 from the low, and still everybody, including everyone in here, is a little bit bearish. Nobody talked about if gold breaks the 1550 point to the upside. Could you talk about the technical standpoints on looking on the upside price, and then give us your final thoughts on where you think it's going to go for the rest of the year?
Yeah, sure thing, Kyle, and it's a great question. I mean, you have to, as I said on GLD, I mean, 150 is just a massive line in the sand. I mean, you can go back to lows in around 150 in late 2011, around May of 2012, and again, after we broke the 150 support area that was holding in late February. So, and broke it hard after the last test in early April. So if we break above 150, I think you can make a case back into, I mean, the 200-day average right now in GLD is just around 160, but I think, there's a longer term case to be made that you can move back to the mid 170s. 174, 175 was a multiple series of highs. So from this perspective, yeah, it could definitely get heated up again if you can get it back over 150. And as I showed before on that monthly chart for GLD, it's technically right at a key test point at 130. So like Kyle alluded to, I think, odds are that we can hold 130, but I do expect in the 3 to 6 month window that we're going to come back down from the current 142 on GLD back to test 130 one more time, because like I said, it just has not acted right. And by right, I mean bullish when it should be bullish. It's basically been flat or marginally higher when you expect it to be a lot higher, and then when there's no news, it's been going down. As Kyle alluded to, GDX is much stronger as a downtrend, and Kyle and I both talked about how the GDX has been vastly underperforming the physical gold or even the GLD tracking vehicle for now the last couple of years. So, from a relative perspective, you have to look at that relative strength and say something's not right with the gold stocks. So certainly if you're looking to be in stocks, gold stocks would be probably the last place I would look. I'd rather look at maybe being long gold and shorting gold stocks if I had to be hedging in some way. But, my view is, probably another test down to the 130 level, roughly 1300, give or take. As Danny mentioned, 1320 is the last key low. Expect that to be tested again. If it breaks, then we could see another round of selling pressure, and it's probably exacerbated by these big hedge fund players like Paulson and Einhorn of Greenlight Capital. I mean, those guys have a lot of money parked in gold thinking it's safe. Guess what? It hasn't been too safe of a play, and they're kind of locked in, and the rest of the market knows it. So they're being their hand is being forced. So that's where a lot of times, as you see one more break of support, sometimes can get that sort of a waterfall decline feeling, at least in the short term. Even if it doesn't intuitively make any long-term sense, that's where the pressure is being felt for these big players that have billions of dollars on the line. So my view is still net bearish and looking for bear opportunities into any further bounce. I expect 145 ought to be a pretty good place to get short GLD if you're not already in it. I think we could bounce a little bit more and then look for a pretty good risk reward trade back down to retest 130 over the next 3 to 6 months.
Yeah, and watch out if those institutions start selling too. If they just start getting killed too much and start selling off, you're going to see a lot more supply into the market too. Price, really appreciate everything. Thanks a lot, Danny. We're going to wrap up with you here. Let's get your opinion on where you think it's going to be heading in, and anything over here on the futures market. Go ahead, Danny.
Well, thanks a lot, you guys. I want to thank Price and Kyle and Todd and Sarah. Look, I'm a futures trader, and I want to make things simple. Like the S&P, there's an old adage about selling in May and walking away, and I think that there's also that tendency for a lot of these futures markets. And the current breakdown in gold right now tells me to kind of stand off a little bit. I'm a seller of rallies. I do want to see how gold acts at the retest if it does get back down there, but to tell you the truth, I think later in the year, going into the October, November, December, you'll start to see a bigger markup in gold, and that would be if I wanted to play that kind of side, I'd probably start to look to buy some type of $15, $50, $15, $16 calls, and in late October, November, December, that's something like that.
All right, thanks a lot, Danny. And again, I just want to say appreciate all three panelists taking your Sunday night and spending it with us. This is what we really like to do is, get rid of all of the yelling on TV you guys hear all day on the major channels, and bring in a topic that you guys want us to discuss and, pull in a lot of different perspectives. That's really what we're trying to do here at Marketfy is cut through all of that. Bring in the real traders, the people that are in the trenches, so to speak, every single day, and get their perspective. And these are successful guys, successful people that have been trading the markets for a long time. So, Todd, Danny, Price, again, we deeply appreciate your guys' time and thoughts here. Everyone, Rick, Azmal, Zalt, Rick again, Jack, EL, Jay, Stan, Audra. We just got a ton of questions in here tonight. We really appreciate your guys' engagement. We hope that we added some value to you and hopefully get you guys head in the right direction in the markets. As always, we appreciate it, and we hope to see you guys next time. This is Kyle Bazzi over here at Marketfy, signing off. Enjoy the rest of your weekend and into the week. See you guys.